When the situation in Iran escalates, then oil prices spike and there's the danger that stock prices crash and with it, of course, crypto as well. Global conflicts do not just destroy cities, they also reprice assets. So let's break down the data. What is already priced in and where might assets still adjust to the current situation? Where are the potential opportunities? Because here is what many people don't understand. Most people think that the market reacts instantly, as in we do get bad news, the oil price spikes, and in the exact same instance, stock prices drop. And then, because crypto tends to be correlated with stocks, might drop even more. But this is not how it works. Instead, we tend to see a delayed repricing, and this is where the opportunity lies. Very often, we see the primary market getting affected first, so in this case oil, and then subsequently, a few days afterwards, other assets tend to adjust to the situation. Now this here, that's the oil price. It went above $100, came crashing down below 80 and is now making another leg up. Now, even when we are crypto native and we don't use traditional finance, there's still ways to bet on the oil price. For example, here on Hyperliquid, that's a perpetual futures exchange. So instead of just betting on cryptocurrencies, there is TradFi over here, and we can bet on oil or uranium or silver or platinum, etc. Now let's try to figure out how much higher oil could potentially go, and thus impact other asset classes as well. Let's have a look at the long-term chart of oil and see how this compares to the monetary base. This here is the US oil price over time in US dollars, and here it is relative to the money supply. So the recent spike in oil is actually a comparatively small repricing event. We have seen much worse rallies in oil before. Now let's have a look at how much the current rally in oil already had an impact on stock prices. That's what we see over here in blue. So in blue, we've got the S&P 500 relative to the money supply. Now, why do I divide both of those price charts by the money supply? It's because the money supply has an impact on all prices. If the money supply is suddenly doubling, then of course, on average, most assets also double in price. So if we just work with a constant money supply, we can then see how the capital is actually shifting. We completely ignore how much new money is entering the market. We do see a slight long-term correlation, as in when oil prices spike, so that was the oil crisis in the 1980s, then stock prices tend to underperform the monetary debasement. When oil prices, however, are rather low, then stock prices can rally. There is no direct connection though, right? Stock prices can very easily crash even though we do have cheap oil prices. So there is an impact of oil, but it's not everything that's driving stocks. No surprise here. This was the dot-com bubble burst. This was the global financial crisis. And interestingly enough, during the global financial crisis, stock prices went down because of the deleveraging event in the property market. That then led to a slower economy, which then led to decreasing oil prices. So this was a spillover effect in the other direction. It was not that oil was expensive and so then the stock market went down. It was rather that the stock market went down and then subsequently oil prices went down as well because of less demand. What we see here at the bottom, that's the correlation coefficient. The correlation coefficient is a mathematical term that oscillates between -1 and +1. This particular coefficient is the 1-year correlation coefficient. So let's talk about correlation coefficients. What is that? When two assets move in the same direction at the same time, so here we've got asset A in red and asset B in green. They tend to move in the same direction at the same time. That's when the correlation coefficient is at 1 or very close to 1. When, however, one asset is going up, in this instance, and the other asset is just doing random things, it sometimes goes up, sometimes goes down, then the correlation coefficient is at 0. So the two assets seem to have no connection with each other in terms of price development. What is -1? It's when the two assets move in opposite directions. So let's say red versus, in this case, dark blue, they tend to move in opposite directions. That's -1. So by looking at the correlation coefficient over time, we can see how much two assets move in tandem with each other. There are several reasons why this metric is important, but for the context of this video, we simply use it as a proxy of how much one asset asset influences another asset. If the two assets tend to move in the same direction at the same time, then they probably have very similar risk factors. Then they probably get impacted by the same fundamentals. This is not, though, what we see for the correlation coefficient between oil and stocks, so the S&P 500. This is just oscillating around zero. In other words, no connection between the two assets, or this thesis here seems to not be that valid. There is a different, very popular narrative though. When oil prices are high, that means that inflation rates might also rise, because a lot of products and services, they are backed by oil. So when oil prices go up, we should expect higher inflation rates. Now, does this hold true? At the top, again, we've got the oil price. At the bottom, we've got the officially measured CPI change year over year. Here we've got again the oil crisis, and this did indeed lead to very high inflation rates in the 15% mark. You can also see whenever we had spikes in the oil price that the officially measured inflation rate tended to be high as well. We also see quite a bit of correlation here, right? The oil price is crashing, the inflation rate is crashing as well. So this theory tends to hold up a bit better. There seems to be a connection between oil and inflation. But this then makes the recent movement particularly interesting. The oil price went up, but the officially measured inflation rate did not yet go up. And this is probably where we will see a repricing of the market. Right? I said at the beginning of this video that very often the market is lagging. And I think this is potentially something that still yet has to be priced in. Of course, there is always a delay with officially measured rates, but we can even see this for metrics that are supposed to measure the inflation quicker. This here is Trueflation, and it measures the inflation based on the basket, but it automatically refreshes the constituents and tries to make a more timely estimate. This estimate is only at 1% per annum, and officially we are currently at 2.4%. And so this is where I like to have this background in finance. I studied financial analysis in Hong Kong, and sometimes having the knowledge of why things move the way they do and how the prices should adjust is very useful. Have a look at this here, for example. This is the US interest rate, so the target interest rate by the Federal Reserve, that's in green, and in blue we've got the CPI. And the CPI has not yet been adjusted. But if the CPI now spikes up because of the high oil prices, which is very likely, right? There was quite a bit of correlation between the two. Then that means that the Federal Reserve will have a hard time cutting interest rates going forward. If inflation is suddenly at 5, 6, 7%, the Federal Reserve will have no interest in loose monetary policy. Check this out. This is the real interest rate. So now we simply subtract those two numbers. We look at the interest rate minus the officially measured inflation rate. Then we get this chart. So how much, at least if we believe the official numbers, do people get in terms of real interest when they buy bonds? And the answer is, if we just take the long-term average, the Federal Reserve tends to set the target rate roughly 1.1% above the inflation rate. And we are very close to that now. So the Federal Reserve is very happy where it's currently at. In other words, in order to cut interest rates more, we'd also need to see lower officially measured inflation rates. But how likely is that? Probably not that likely. So where in the market should we see the repricing? And let's say the market now suddenly wakes up and sees that maybe interest rate cuts are a thing of the past, and that maybe we see even monetary tightening going forward. What assets will reprice the fastest once we've got that realization? The answer is we will see this in the bond market. Now, bonds are simply instruments that pay a fixed coupon every year, for example. It can be semi-annually, it can be quarterly, but there is a regular predictable cash flow, let's say of $100. At the end, the principal is paid back as well, but the cash flows of a bond are 100% predictable. They are already predetermined at the issuance of the bond. Now, the price of the bond changes over time. The price is not constant. The future cash flows are constant, but the price of the bond is not. And that's because the value of those future cash flows changes over time. We have to discount those future cash flows. If we get this principal payment, say 10 years from now, and let's say that's $1,000, then those $1,000 10 years from now are much less worth to us than $1,000 we would get today. That's because of two reasons. First of all, there is inflation, so that's reason number one. But reason number two is we simply have a time preference. We do want to have the money now, not in 10 years. We might die in 10 years. The world might not exist in 10 years. And in general, give it to me today, not in 10 years. We have a time preference and we want to be compensated for future inflation. So everything that comes in 10 years, that's worth to us less. The further it's out in the future, the less it's worth to us. So we have to take a discount. We have to reduce the value of those future cash flows. You have to reduce this more and more based on how far this is out in the future. Now, there is a way to discount this. There is a mathematical way to say how much less this future payment will be worth to us. The present value of a cash flow is equal to the cash flow divided by 1 plus the risk-free rate. And the risk-free rate is the target rate, the Federal Reserve rate. We then have to compound this by the number of years. So in this case, let's say 10 years. So in this particular example, it would be $1,000 divided by 1.04. The target rate is slightly lower than that, to the power of 10. This term here is roughly 1.5. So really, this cash flow here is only worth $666. Roughly. A bit more than that. Now, why do I talk about this? I talk about it because it gives us a framework of how to price bonds. If interest rates go up and we have to discount the future cash flows more, then the price is going down. If interest rates go down, then the price of bonds should go up. The longer the duration of the bond is, as in the further out the cash flows are, the more sensitive they are to interest rate movements. Now, let's bring this back to our charts. If oil continues to go up and stays at this level, and then officially measured inflation rates go up, that means the Federal Reserve will have a hard time cutting interest rates more because it's already at its long-term equilibrium, and so it might even raise interest rates. And then instruments like TLT, they should come down. Now, TLT is a long-term government bond ETF. So if interest rates go up, then TLT goes down. If interest rates go down, then TLT goes up. And we haven't really seen that much of a change here just yet. We are unchanged since beginning of the year, but the oil price is very far away from being unchanged. Since beginning of the year, it went up by 60%. And so this is where potentially the opportunity is here, right? The market is not yet pricing in that interest rates might suddenly turn around, that it's over with the interest rate cuts. If, of course, we continue to see this chart going up, or at least staying at the elevated level. The connection of bond prices relative to the estimates of future Federal Reserve interest rate developments is undisputed, because this is really the main driver. It's the interest rate and maybe the risk premium on the US government defaulting, but it's those two things that determine the price of bonds. I do not think, though, that the war in Iran and the rising oil prices have directly an impact on stock prices, because stock prices can adjust. If suddenly the monetary base was to expand and the US dollar is worth even less and inflation rates go up, then tech companies can simply reprice their products. Of course, if tech stocks were to fall, so that's here at the top, then Bitcoin would probably also fall, because tech stocks and Bitcoin is very much correlated. But I don't really think that tech stocks will be impacted by the crisis as much. At least if the crisis stays where it is and it doesn't expand further to, let's say, a crisis even in Taiwan, where the GPU supply might get cut off. But really, there is not that much connection between the target interest rate here at the bottom and technology prices. When rates come down, that's in theory good for asset prices, because we have to discount future cash flows a bit less. And we did see the Nasdaq 100 going up during that period. But even during monetary contraction, when interest rates went up, we saw technology stocks going up. Then we saw a crash in interest rates, which did not help technology stock prices. We saw a contraction, which did not push down prices. So really, for stocks, the connection is much, much more loose. I do not think that the policy by the Federal Reserve impacts stock prices and, as an extension, crypto prices as much as people make it out to be. It does have an impact on the bond market, but it doesn't have as much of an impact on stocks. Because in theory, technology stocks should even be more impacted by monetary policy. But obviously, in practice, they are not. There is no real connection between the price of technology stocks and interest rates. Now here's why I say that technology stocks should in theory be more impacted by them. Let's take a regular stock that's not technology, a consumer stock. Let's say we've got Coca-Cola, so let's make this say in red, right? We've got relatively predictable dividend payments. They might go up over time slightly, but it's relatively predictable and it's relatively steady. That's Coca-Cola. Let's look at something that's much more risky. Let's have Microsoft, for example. Microsoft did not pay any dividend for its first 2 decades being listed on the NASDAQ 100. What then happens is small payouts, and then those payouts grow much more. The payouts are very much backloaded. Most value is maybe in the year 20 from now, not today. So really we have to discount things very heavily. When we discount the cash flow, we take our estimate of what that cash flow will be, and we then divide this by whatever our interest rate assessment is to the power of, in this case, 20 years. So we discount it a lot. It's 20 years out in the future. If we now have a lower interest rate, instead of 1.05, it's a 1.03, then we have to discount it much, much less. Thus, the value of this massive future cash flow in the future will be higher to us. So we've got more interest rate sensitivity, in theory, for growth stocks compared to just say Coca-Cola. But that's the theory, right? That's what people learn in academia. But in practice, we do not see that. In practice, interest rates go up and down, and the NASDAQ 100 doesn't care at all. We can see monetary tightening, yet technology stocks continue to go up. We can see a cut in interest rates, technology stocks go up. There's really no hard connection between the two. And so I make this video partially just to explain that really you might not want to always listen to the news. You might not always want to just look at what is the Federal Reserve doing, how will interest rates impact stocks and crypto, etc. The connection is very, very loose. There is a connection between the bond market and all of those things, but do not overestimate how much impact the Federal Reserve really has on asset prices. Sentiment moves asset prices much, much more. If people see .com companies going bust, that's when prices go down. If people lose their homes, that's when prices come down. But if there's no real trigger, no real reason to sell, prices just stay elevated. And so, of course, still feel free to follow the news on Iran, but do not think that just because oil is going up that your portfolio will get crushed. But be aware that in a few weeks from now, people might notice this potential change in the Federal Reserve policy. Officially measured inflation rates will very likely go up, and the Federal Reserve will change its policy based on that. And this will have an impact on long-term government bonds, but it might not have an impact on much else, unless, of course, the war expands way beyond its current scope. If you got some value out of this video, feel free to give this a like. It will help the channel grow. Feel free to also subscribe. I publish videos regularly on this channel. If you want to, if your portfolio is large enough and you want to dive deeper in those topics, you can also check out the premium membership. Link to premium is down below. Thanks for watching. See you next time. Cheers.